You know, usually when we talk about a medical diagnosis, there is this expectation of like clinical precision. You break your arm, the x-ray shows that jagged white line, and the doctor just points at it. It is binary, broken or not broken.
Right. It is comforting because, well, we like things to be visible. We want complex systems to just be easily categorized.
Exactly. But then you step into the world of global finance, and suddenly that x-ray machine is scanning something infinitely more complex than a single bone. It is scanning the entire nervous system of the global economy.
Oh, that is a great way to look at it.
And today, for our deep dive, we have our hands on one of the highest resolution x-rays available out there. We are looking at the Q2 2026 earnings call transcript of the Goldman Sachs Group.
Which is just a massive treasure trove of data.
It really is. We're looking directly at where the most powerful corporations on Earth are placing their multi-billion-dollar bets right now. And I mean, the headline numbers here, they're just absolute blowout stats.
Yeah, they really are.
We are talking record net revenues for the quarter of $20.3 billion, record earnings per share of 20.98, and a return on equity of 23.5%.
I mean, when you look at that $20.3 billion, you have to really think about the velocity of that money.
Right.
Over the course of a 90-day quarter, this firm generated roughly $225 million in revenue every single day.
That is just hard to wrap your head around. $225 million a day.
Yeah, it is staggering. But the raw numbers aren't even the real story here. The story is the structural mechanism that is actually generating this.
Right, how and the why.
Exactly. We are looking at a massive artificial intelligence infrastructure boom. And by that, I mean the physical steel and copper, not just, the software side of things.
Right.
Plus, we are looking at how market volatility is being engineered into this crazy profit engine. And there's this massive flywheel effect where a single conversation in a boardroom translates into decades of compounding revenue.
Well, let's actually tear right into that flywheel effect. Because if we want to understand how you generate $225 million a day, we have to look at the primary engine. And the source material clearly identifies that engine as strategic deal making.
Yes, the M&I pipeline.
Right. The transcript highlights that large cap corporate mergers and acquisitions are up 90% in the first half of 2026.
90% is a massive jump.
It is huge. They advised on a staggering $1.2 trillion in announced deals. And they didn't just participate, they totally dominated. They secured a lead of $425 billion ahead of their closest peer.
And that gap between them and the number two player is where you really start to see the structural advantage.
How so?
Well, capturing a disproportionate share of the most consequential transactions globally, it gives you unparalleled visibility into where the global economy is heading. You see the board before anyone else does.
And they named some of these marquee deals on the call, which really puts it into perspective. We're talking about acting as the lead left book runner for the record-breaking SpaceX IPO.
Right.
They did the equity raise for Alphabet. They advised on the massive Dominion Energy sale to NextEra Energy and Comcast's spinoff of NBC Universal. I mean, These are massive household names fundamentally restructuring their entire corporate architecture.
Yeah, these are the deals that reshape entire industries.
But, I want to push back on this a little bit.
Okay, go for it.
The management team repeatedly attributes this massive pipeline to their one Goldman Sachs operating ethos. They claim they have broken down internal silos, so investment bankers, traders, and wealth managers are all working together to multiply revenue from a single client.
Right, the flywheel.
Honestly, that just sounds like a classic cross-selling scheme.
You think so?
Well, yeah. I mean, we have seen consumer banks get in massive regulatory trouble for forcing clients into interconnected ecosystems, like opening accounts people didn't want. What makes this different? Why is this a flywheel and not just aggressive upselling?
It is a very valid skepticism, for sure. But the mechanics here are fundamentally different from retail cross-selling, mostly because of the sophistication of the counterparty and the actual nature of institutional risk.
Okay, unpack that for me.
So this isn't about pushing an unwanted credit card onto a checking account customer. Think about the life cycle of trust in a mega merger. Let's look at that Dominion Energy and NextEra deal.
Right, the huge energy merger.
Yeah. If a bank advises on that merger, they have just spent 18 months in the trenches with the CEO and the board. They have built the financial models. They know exactly where every skeleton is buried in the balance sheet.
So they have this incredible information advantage.
An immense information advantage. So when the newly combined entity suddenly needs to raise, say, $10 billion to actually finance the acquisition, who are they going to trust to syndicate that debt?
The people who already know the math.
Exactly. The bank that already knows the math inside and out. But it goes even deeper than that.
How much deeper?
Well, the combined company now has massive new currency exposures and floating rate debt risks because of the deal. So the bank's trading floor steps in to provide interest rate swaps and derivative hedges to neutralize those specific risks.
Okay, I see the mechanism now.
Eh.
It is kind of like being the architect who designs a massive skyscraper. Because the client trusts your blueprints implicitly, they naturally hire you to finance the construction.
Right.
Then they hire your specialized subsidiary to manage the HVAC systems, and eventually they hire you to manage the personal wealth of the CEO who commissioned the building in the first place.
That is the perfect visualization. The advisory fee, the headline number you see in the financial press when a merger is announced, that is really just the top of the funnel.
Just the tip of the iceberg.
Yeah. The real money is in the derivative hedges, the debt syndication, and eventually the private wealth management. When the founders of the acquired company suddenly find themselves with $500 million in liquid cash, the bank's wealth management arm is already sitting in the room with them.
Wow. The numbers certainly support that ecosystem. The CFO actually noted their investment banking backlog increased to its highest level in 5 years.
Right. The pipeline is packed.
Yeah. So even while printing record revenues and closing these massive deals today, the pipeline of future deals is overflowing. But it makes me wonder, why are all these mega-cap CEOs suddenly so desperate to merge right now? In 2026, what is driving a 90% spike in M&A?
The transcript gives us a very clear two-pronged answer to that. It is the pursuit of scale driven by technological pressure, combined with the sudden slackening in the regulatory leash.
The regulatory leash, right.
Yeah, management explicitly noted that clients are pursuing massive scale to invest and compete more effectively.
Right. The CEO mentioned that we're in a regulatory environment where if a company asks if they can inorganically enhance their competitive position, which is just a fancy Wall Street way of asking if they can buy a rival, the answer today is maybe.
Right.
Whereas a few years ago, the antitrust regulators would have given an absolute, unquestionable no way.
Exactly. We have seen a massive shift in the antitrust landscape globally. CEOs recognize they have a finite multi-year window right now to execute structurally scale-enhancing deals.
Because they don't know when the regulatory window might close again.
Exactly. And if you are a mid-sized player in, say, telecommunications or energy, and you realize you need to spend $20 billion on new technology just to survive the next decade, well, you just can't do that alone. You have to merge.
Which bridges us perfectly into the actual destination of all this capital. We see trillions moving around in these M&A deals, but what is absorbing all this cash?
The black hole of capital.
Right. The earnings call made it undeniably clear. It is the physical reality of artificial intelligence. And I want to emphasize that word, physical.
Yeah, that is crucial.
The CEO pointed out that the AI investment cycle is expanding its capital needs way beyond core technology right now.
This is honestly the most critical shift for anyone trying to understand the current macro environment. We are moving out of the software phase and into the heavy industry phase of AI.
We aren't just talking about writing code anymore, or even just designing silicon chips. We are talking about hard infrastructure,
right?
Energy grids, nuclear power facilities, massive water-cooled data centers that take up hundreds of acres.
And building this physical AI infrastructure requires capital formation on a scale we haven't seen in decades. I mean, you have to finance the power plants that will generate the megawatts, to power the data centers, to house the servers, to actually run the models.
It's an entire supply chain.
Yes.
Yeah.
It creates a multi-year ripple effect across real estate, public utilities, specialized manufacturing, and logistics.
I think a lot of people, when they hear AI, they still visualize it as something that just lives in the cloud, like it is weightless.
Yeah, just invisible magic.
Right. But the reality is that the cloud is made of concrete and copper.
And this is exactly why a global investment bank is so heavily involved here. Think about the transatlantic fiber optic cable boom in the late 1990s.
Oh, that's a good comparison.
The companies laying those cables across the ocean floor, they had to take on massive existential financial risk before anyone really knew how much internet data would eventually flow through them.
They were just laying pipe and hoping for the best.
Exactly. And AI infrastructure is the exact same dynamic today. You are dealing with multi-year, multi-billion-dollar construction projects that require highly structured project finance.
So they need the banks to structure it.
Right. You need to tranche the debt, syndicate the loans across hundreds of institutional investors, and hedge the construction risk.
Now, in the Q&A portion of the call, An analyst actually brought up this exact risk. They quoted a recent press clipping where the Goldman CEO said there's currently more greed than fear in the market.
I remember that, yeah.
The analyst essentially cornered management and asked, are we looking at an AI investment bubble? If we are laying the equivalent of transatlantic cables, how comfortable should we be with the durability of this financing boom before the bubble pops?
It is the trillion-dollar question, isn't it? And management's response was really a masterclass in risk framing. They didn't offer blind, unchecked optimism.
No, they didn't.
The CEO stated that we are in the early innings of a deeply significant build-out, but he explicitly warned of short-term turbulence.
He used the phrase bumps and recalibrations over the next 6 to 18 months.
Precisely. Because right now, there is tremendous uncertainty regarding the unit economics of AI.
What do you mean by unit economics in this context?
Well, once this massive infrastructure is built, how will enterprises actually buy it? How will it be priced? They specifically mentioned the costs of token spend.
Token spend.
Yeah, which is the computational cost of actually querying these large AI models. If the cost of a token remains too high, corporate adoption slows down.
And if adoption slows down,
then the data centers don't generate the expected yield, which ripples right back to the debt used to finance them.
So we should absolutely expect volatility in the short term as the market figures out this pricing model.
Yes, definitely. And this is why the bank is leaning in so hard. When management looks at the 3 to 5 year trajectory, they are highly confident. The absolute physical demand for electricity and compute power is undeniably massive.
Right.
And the more complex and expensive this infrastructure becomes, the more it requires a financial institution with global breadth, deep engineering capabilities, and an impenetrable balance sheet to underwrite it.
Okay, so the AI build-out is this long-term, multi-year physical reality playing out in concrete and steel. But the day-to-day stock market is reacting to this in real time, minute by minute, and it is chaotic.
Extremely chaotic.
And that chaos brings us straight from the investment banking boardrooms down to the trading floors. The equities revenue for this quarter alone hit a record $7.4 billion.
That number is just staggering for a single quarter of equities trading and financing.
It really is.
Yeah.
And they zeroed in on the exact mechanical dynamic that drove it. The CFO noted that single stock volatility and dispersion remain high.
Yes, dispersion.
And the CEO elaborated later, pointing out that this dispersion is happening even while the overall market index is trending upward. I want to spend a minute here because understanding dispersion is critical to understanding how Wall Street thrives on chaos.
It is the key to understanding why the bank's profitability isn't strictly tied to whether the stock market is simply going up or down.
Right. So think about the overall stock market index, like the S&P 500, as a rising tide. Over the last year, that tide has generally lifted the fleet of boats.
Okay, sure.
But underneath the surface of that rising water, the individual boats are violently thrashing. Some boats are getting caught in massive updrafts and shooting into the air, while others are plunging into deep troughs and crashing into each other.
It's messy under the surface.
Exactly. That violent individual thrashing beneath the surface, that divergence in performance between individual companies, that is dispersion.
And that thrashing is incredibly lucrative for a bank.
How does that make the money if the boats are crashing?
Because when individual stocks are experiencing wild, unpredictable swings, even if the overall index is slowly grinding higher, institutional clients simply cannot sit still.
They have to react.
Right. If you are managing a $50 billion pension fund or you're a quantitative hedge fund, you are forced to react to that thrashing. You need liquidity to rapidly reposition your portfolio.
You have to move fast.
Exactly. You need to buy and sell massive, complex blocks of shares. And most importantly, you need to buy risk management solutions like options, swaps, and other derivatives to protect your portfolio from the boats that are crashing.
And every single time one of those funds needs to trade a block of shares or buy a derivative to hedge their downside risk, who do they call?
They call the bank's trading desk.
Exactly. They call the bank. The bank acts as the intermediary. They provide the liquidity, they structure the derivative, and they collect a spread, a premium, or a fee on every single transaction. The house always takes a cut of the chaos.
And management explicitly stated this. The CEO noted that this specific concoction of high individual stock dispersion relative to a stable overall index is incredibly supportive of the intermediation activity clients are forced to undertake.
What I found fascinating was where a lot of this trading activity is physically located.
Oh, the Asia piece.
Yes. During the Q&A, an analyst from UBS asked about the equities number. And she actually pointed out that there was a collective chuckle across the street when the numbers were released.
Because the outperformance was just so massive compared to their competitors.
Right. Everyone was just kind of shocked. She wanted to know how much of this was driven by the Asia hyperscale trade.
This is a fantastic example of a long-term strategic bet paying off against short-term skepticism.
Tell me about that.
Well, management detailed how a few years ago they recognized a glaring competitive weakness in their Asian equities and prime financing businesses. They were losing market share to regional competitors.
They were falling behind.
Yeah. So they deliberately deployed massive human capital, technological infrastructure, and balance sheet resources to capture that market.
And they took a lot of heat for it from analysts earlier in the year, right?
Oh, yeah.
The CEO admitted that when they ramped up this heavy investment in the first quarter, analysts were practically demanding to know if it was sustainable or just a total waste of capital.
But they held their nerve. They had received some regulatory capital relief at the turn of the year, and instead of just sitting on it, they aggressively funded this Asian expansion.
Where specifically were they looking?
They specifically targeted the robust AI capital formation and trading activity happening in markets like Japan and Taiwan. And by the end of the second quarter, those investments yielded record average prime balances and massive market share gains.
Now, you just mentioned prime balances, which refers to prime brokerage and prime financing. This actually leads us into something deeply counterintuitive that was discussed on the call regarding how a bank restricts its own growth.
The regulatory constraints.
Let's dig into that. When we talk about prime financing, we're basically talking about the bank lending money and securities to hedge funds, so those funds can apply leverage to their trades. Right?
Exactly. It is historically a highly profitable, relatively low-risk business for the bank, assuming the loans are properly collateralized.
Right. But the CFO explicitly noted that client demand for this financing actually outstrips the bank's willingness to supply it.
Yes, they are turning business away.
Which is wild. If hedge funds are banging down your door asking to borrow money, and you make a solid secured profit on that lending, why on earth would you say no?
Because of the mechanical reality of regulatory capital constraints, specifically a metric called the supplementary leverage ratio, or SLR.
The SLR.
Yeah. In the Q&A, an analyst pointed out that Goldman's SLR had fallen to 4.3%, which made it the lowest among its peer group.
Let's break down exactly how the SLR works. Because for you listening, it is important to know this is not just a suggestion. It is a hard legal limit.
The SLR was designed by regulators after the 2008 financial crisis. Unlike other capital requirements that weigh the riskiness of an asset, the SLR is a completely blunt instrument.
How so?
It requires banks to hold a minimum percentage of Tier 1 equity capital against their total leverage exposure, meaning the sheer size of their balance sheet, regardless of how safe those assets actually are.
Right. So even if a bank lends $10 billion to a hedge fund, and that loan is 100% secured by ultra-safe U.S. Treasury bonds, that $10 billion still expands the denominator of the leverage ratio.
Exactly. The gross exposure goes up.
The Federal Reserve essentially says, we don't care how safe the collateral is, your balance sheet just got bigger, so you need to hold more equity against it.
Exactly. Every single trade, every prime financing loan consumes balance sheet capacity. So the management team is constantly performing this incredibly complex, multidimensional juggling act.
It sounds stressful.
It is. They have to balance the intense, highly profitable client demand for financing against their binding regulatory constraints. Not just the SLR, but also their CET1 ratio, which is their common equity Tier 1 capital.
So they are practically forced to be picky. As the CEO said, they are at a moment in time where the demands for financing simply outstrip the appropriate quantum of capital they are willing to deploy.
Right.
But here's the brilliant part. Because they are constrained, it actually gives them pricing power.
It is basic supply and demand. When you hold a scarce resource, in this case balance sheet capacity, and client demand exceeds your supply, you get to dictate the terms.
You hold all the cards.
Exactly. You choose only the highest margin clients, you demand better pricing, and you optimize your overall return on equity.
So if we step back for a second, all of this corporate maneuvering, the trillion-dollar M&A advisory, the massive equities trading volumes, the highly optimized prime brokerage, all of this activity generates vast oceanic amounts of liquid cash for their clients.
A tidal wave of cash.
Which leads us to the ultimate destination of the flywheel, asset and wealth management.
The scale of this division is almost difficult to even comprehend. They reported $4.6 billion in revenue for this segment alone, up 20% year over year.
That's just the revenue.
Right. But the true metric of power here is the assets under supervision, which crossed the $4 trillion mark.
$4 trillion.
Yeah, $4 trillion. And their wealth management client assets alone hit a record of roughly $2 trillion.
To tie this back to the flywheel we discussed earlier, the CEO highlighted a data point that I found absolutely stunning. Since the start of 2025, there have been nearly 900 referrals directly from their investment banking division over to their wealth management division.
I mean, think about the mechanics of that.
Walk us through it.
It is the ultimate realization of the strategy. An investment banking team advises a founder on selling their private tech company for, say, $800 million. The deal closes. The founder suddenly has a massive liquidity event.
They are suddenly incredibly rich in cash.
Right, so they need to manage the tax implications, set up generational trusts, and invest that cash. The investment banker doesn't just say congratulations and walk away.
No, they don't want to lose that money.
Exactly. They walk that founder down the hall and introduce them to a private wealth advisor. The bank engineered the transaction that created the wealth and then immediately captured the wealth to manage it in perpetuity.
And it isn't just individual billionaires either. It is massive institutional pools of capital too. The transcript highlighted incredible momentum in their alternative assets platform.
Right, the alt space.
They raised a record $59 billion just this quarter, bringing the year-to-date total to $85 billion. And $31 billion of that this quarter was strictly in private credit.
Private credit is exploding right now.
I want to drill into private credit, actually, because this is a massive structural shift in how the world borrows money. Why are tens of billions of dollars flooding away from public markets and into private credit?
It is a structural evolution in lending. Historically, if a mid-sized corporation needed to raise $500 million, they would issue public bonds, or they would go to a syndicate of banks for a leveraged loan.
The traditional routes.
Right. But public bond markets are volatile, and heavily regulated bank syndicates can be slow and inflexible. Private credit completely bypasses all of that. It involves a massive asset manager lending directly to the borrowing company.
So it is a bespoke, one-on-one negotiated loan.
Exactly. For the borrower, they get speed, certainty of execution, and highly customized loan structures that public markets simply can't offer them.
What about for the investor?
For the investor providing the capital, like a sovereign wealth fund or a pension plan, they get what's called an illiquidity premium. Because these loans aren't traded daily on an exchange, they typically offer significantly higher yields, often floating rate, which protects against inflation.
So Goldman Sachs is leveraging its massive corporate relationships from the investment banking side to originate these private loans and using its asset management side to fund them.
You've got it. That's the flywheel again.
They also mentioned a massive institutional win on the call that perfectly illustrates this scale. They were appointed to take over the retirement plans for Verizon and Lockheed Martin.
Huge, huge brands.
This is a $70 billion outsourced Chief Investment Officer, or OCIO, mandate. Let's unpack the mechanics of an OCIO mandate, because $70 billion is an astronomical sum for a single deal.
Think about the core business of a company like Lockheed Martin. They build advanced aerospace technology and fighter jets.
Right.
But because of their history, they also happen to have a massive legacy pension fund with tens of billions of dollars that they are legally obligated to manage for their employees' retirements.
Which has nothing to do with building jets.
Exactly. Managing that money across global public equities, private credit, and real estate requires an entire internal asset management firm.
Plus, they have to manage the liability side, matching the duration of their investments to the exact dates their employees will retire over the next 50 years. I mean, it's an actuarial nightmare.
Precisely. It is incredibly complex, highly regulated, and a massive distraction from their core competency. So large corporations are increasingly throwing their hands up and saying, we don't want to be in the pension management business anymore.
They just want to outsource the headache.
Exactly. They completely outsource the chief investment officer function to a firm like Goldman Sachs. Goldman takes over the entire $70 billion pool of assets. They apply a customized asset allocation model, handle the duration matching, execute the trades, manage the risk, and charge a recurring basis point fee for providing a comprehensive turnkey solution.
That is the definition of sticky recurring revenue.
Ah, very sticky.
But there was a nuanced detail in the Q&A regarding how this revenue actually hits the income statement.
Right.
An analyst asked a really astute question about those massive fundraising numbers in alternative.
About the timing of it, right?
Right. If you raise $59 billion in a single quarter, you don't instantly start collecting fees on all of it, do you?
No, you don't. And this is vital to understanding the long-term profitability of the firm. Management had to explain the mechanics of undeployed capital, which the industry calls dry powder.
Dry powder.
Yeah, and the concept of a laddered portfolio. When a major institutional investor commits $500 million to a new Goldman Sachs private equity or private credit fund, the bank doesn't instantly go out the next morning and buy $500 million worth of assets.
Because forcing capital into the market too quickly leads to bad investments, right? You have to wait for the right opportunities.
Exactly. They call that capital from the investor slowly over several years as they originate the right loans or find the right acquisition targets.
Okay, that makes sense.
And crucially, they generally only recognize the bulk of their management and incentive fees once that capital is actually deployed into the market and begins generating returns.
The J-curve effect.
Yes. So what this massive $85 billion year-to-date fundraising number actually represents is stored energy.
I love that phrase, stored energy.
It is a massive embedded runway for future revenue. Even if the global economy slows down next year and fundraising totally dries up, the firm has tens of billions of dollars of dry powder sitting there waiting to be deployed. As they slowly deploy it over the next 3 to 5 years, it will activate new recurring revenue streams long into the future.
It is a brilliant, highly insulated business model.
It really is.
But here is the paradox. Managing $4 trillion in assets, executing trillion-dollar M&A deals, and running global trading desks requires a massive, complex operational engine. How is the firm handling this record blowout volume internally without their operational costs absolutely spiraling out of control?
This is where we see the concept of operating leverage playing out in real time.
The CFO provided a statistic during the Q&A that honestly made me do a double take. He noted that their revenues grew at an incredible 40%, but their compensation expenses, the money they pay their people, only grew at 30%. And their non-compensation operating expenses grew at just 22%. But here's the real kicker. Overall headcount at the firm is actually down 2% quarter over quarter.
Wow.
They just reported the highest net revenues in the history of the firm, and they did it with fewer people than they had 3 months ago.
That is the holy grail of corporate efficiency right there, generating significantly higher marginal revenue without a corresponding increase in your human capital footprint.
But how are they actually achieving that mechanically? Is it just senior bankers cracking the whip and forcing associates to work 120-hour weeks?
Well, the intensity of the culture is, well known. The structural answer here is technology. Management explicitly connected this operating leverage to an initiative they called GS 3.0 and their aggressive internal integration of artificial intelligence.
So they're using AI on themselves.
Yes. They aren't just financing the physical AI revolution for the tech giants, they are weaponizing it internally.
The CEO detailed how they are taking large language models, transformer networks, and pointing them inward. They are integrating these models with Goldman Sachs' highly differentiated, curated historical data.
Which is massive.
We're talking about proprietary vector databases containing 40 years of M&A transaction models, trading data, and risk analytics.
Exactly. By applying AI extraction and analytic tools to that massive closed-loop data set, they are making their existing highly paid talent exponentially more productive.
Making them faster.
The CEO noted that AI expands the capabilities of their best-in-class talent and increases their capacity to drive commercial impact. They are automating the rote mechanical process improvements, the sort of table stakes data gathering.
Allowing them to do more deals?
Right. It allows their bankers to offer faster, more complex, and more insightful analysis to clients without needing to hire an army of support staff to crunch the numbers.
But this raises a profound structural question. If you are an entry-level analyst listening to this right now, this should be setting off alarm bells.
Oh, absolutely.
If AI is making existing senior bankers and mid-level associates so incredibly productive that the firm doesn't need to replace departing staff, hence the 2% drop in total headcount, are we seeing the beginning of the end for the traditional entry-level Wall Street analyst?
It's entirely possible.
Think about the 22-year-old kid straight out of an Ivy League school whose historical job was to spend 80 hours a week formatting PowerPoint slides, pulling SEC filings, and manually updating historical data in Excel models.
The grunt work.
Right. If an internally trained AI model can generate that entire slide deck and populate the model flawlessly in 30 seconds, what happens to that entry-level pipeline?
It is an existential question for the apprenticeship model of high finance. The CEO was very careful in his phrasing on the call.
What did he say?
He stated that AI will, quote, change how work gets done. It will not replace what matters most, our extraordinary people.
Of course he's going to say that.
Right, but you have to look at the math. The marginal levels of revenue production are growing significantly faster than their human capital. The nature of entry-level finance work is fundamentally shifting.
How so?
Instead of spending your first 2 years proving your worth by staying awake for 48 hours to manually gather data, young bankers will have to prove their worth by interpreting AI-generated data and understanding complex client psychology much earlier in their careers.
The bar for entry isn't just going up. The entire nature of the game is changing.
Completely changing.
But all of this internal efficiency, the GS 3.0 automation, the strict headcount management, it translates directly into a massive financial windfall for one specific group of people.
The shareholders.
Yes. The firm generated so much excess capital from these record revenues while operating so efficiently that they were able to return an absolute mountain of cash to the people who own the stock.
Let's look at the mechanics of how a bank actually figures out how much money it's allowed to give back to its shareholders because, as we discussed, it is heavily regulated. The CFO walked through their capital management priorities. Despite deploying capital aggressively to support all that client financing we talked about, they still built a Common Equity Tier 1, or CET1, capital ratio of 12.9%.
Let's explain why that 12.9% number is so critical. Because every year, the Federal Reserve conducts a comprehensive capital analysis and review, the CCR stress tests.
The stress tests, right.
They simulate a severe global economic collapse, a massive spike in unemployment, a crash in commercial real estate, a severe recession. They force every major bank to run their balance sheets through that nightmare scenario to see if they survive.
And based on how much money the bank loses in that simulation, the Fed dictates exactly how much equity capital the bank is legally required to hold and reserve at all times.
Precisely. It acts as a shock absorber for the financial system. Goldman passed the severe stress test, and their required minimum CET1 ratio was set at a certain level.
Right.
By operating at a 12.9% ratio, they're holding a massive 950 basis point buffer above what the government requires. They have an impenetrable fortress balance sheet.
So they have satisfied the regulators, they have funded all their clients' massive M&A and AI deals, and they still have billions of dollars in excess cash sitting around. What do they do with it?
They give it back.
They return it aggressively. They increase their quarterly dividend by 25% to $5 a share. And to put the velocity of that growth in context, they have increased the dividend by 150% over the last 5 years.
But the dividend is really just the start. The truly aggressive capital return mechanism is the share repurchase program. They bought back $4 billion of their own common stock in a single 90-day quarter.
$4 billion in one quarter.
And we should explain the math of a stock buyback for you, because it directly manipulates the headline numbers we discussed at the very beginning of the deep dive.
How so?
When a company takes $4 billion in cash and buys its own stock on the open market, it retires those shares. They basically cease to exist. This reduces the total number of outstanding shares in the world.
Exactly. So when the firm generates its quarterly profit, that profit is now divided among fewer surviving shares. It artificially boosts the earnings per share, or EPS metric.
It makes every remaining share inherently more valuable because it represents a larger percentage ownership of the firm's total earning power. It is a relentless, highly engineered, profit-generating and shareholder-rewarding machine.
It really is. So if we pull all of these complex threads together to kind of synthesize what we've actually learned from this transcript.
Yeah, let's tie it all together.
The Q2 2026 earnings call isn't just a spreadsheet of record revenues and regulatory ratios. It is a cohesive narrative of a highly interconnected global financial ecosystem functioning at peak efficiency.
Everything feeds everything else. The AI infrastructure build-out, the concrete, the copper, the power grids, that requires massive capital formation.
Right.
That desperate need for capital and scale drives corporate M&A. That M&A activity requires the bank's advisory and debt syndication arms.
It is a massive loop.
The resulting macroeconomic shifts and market volatility create dispersion in the stock market, driving institutional clients to the trading floors for liquidity and derivative risk management.
Right, feeding the trading desks.
Exactly. All of this corporate maneuvering creates vast personal and institutional wealth, which flows right back into the bank's asset management arm via private credit and OCIO mandates.
And internally, customized AI is supercharging the efficiency of the very people managing this entire process, allowing the bank to return billions to its shareholders.
It is the ultimate realization of the One Goldman Sachs flywheel. Every single business unit feeds into and accelerates the others, protected by a fortress balance sheet, constrained only by regulatory speed limits, which actually grant them pricing power, and driven by deep, long-standing client relationships.
It really is a masterclass in architectural corporate strategy.
But as we wrap up this analysis, I want to leave everyone with something to mull over on your own. We have talked extensively today about the billions of dollars flowing into physical data centers and the internal AI tools making analysts lightning fast today.
Right.
But the management team stressed repeatedly throughout the call that their ultimate unassailable moat is the trust they have built in corporate boardrooms over decades. It's built on human relationships.
The role of the trusted advisor, knowing the CEO, knowing the board, having history.
Exactly. But if the entire flywheel fundamentally relies on those deep human relationships, built over expensive dinners, shared histories, and handshakes, what happens in 10 or 15 years when the generation raised entirely on AI-generated analysis takes over the C-suite?
That is a great point.
Will trust still be built over a handshake and a shared history? Or will the algorithm dictate the deal? If a competing bank's AI can objectively mathematically prove that their financing structure for a merger is 2 basis points cheaper and structurally superior, does the historical trusted relationship still win the mandate?
That is a phenomenal question about the future of human capital in high finance. When the math becomes perfectly commoditized by AI, does the human relationship become more valuable or entirely obsolete?
It is the tectonic shift we will definitely be watching closely. Thank you so much for joining us on this deep dive into the underlying mechanics of the global economy. Keep exploring the data, keep reading the transcripts, and keep questioning the systems running the world around you.